The recording. Good morning, everyone. I think this morning for most of us, except maybe afternoon for those of you joining us from Singapore. My name is Andre Castaman, and I'm delighted to be here with you this morning for a special ITFA online meeting for the Indian banks. This is actually one of the outcomes from Pinaki's work with your community since decades, I should say, and over the last year or 2 years, Pinaki has gathered us on a WhatsApp group, which is a pure delight because we're exchanging news on a continuous basis, even during the weekends. And I thought, as we all tried to meet on the 27th of April and with COVID, Pinaki and I thought might be good to get everyone on technology in order to exchange some views on what's happening on the tech side, but also on the policy side, and try to determine together what else is needed to make sure technology benefits can be extended to many more players thanks to additional policy decisions. So that's really the theme of this session. We have the pleasure of having very experienced people with us, and I'm going to present them here. Sean Edwards is with us. Sean is chairing the ITFA, so the International Trade and Forfeiting Association, since years, if not a decade. A member of the ICC EXCO, which is critical given the role of ICC in this space, and head of legal at SMBC Europe, which is also critical because the legal issues is where most of the work still needs to be done. Alex Goulandris is CEO of SDocs and very relevant for this session, of course, but also critical role on the ICC side, as we all know, and as part of our WhatsApp group. And then I have invited two of our FinTech members on the ITFA side, because those recent technologies are addressing specific needs in origination, in distribution. We're going to hear more about it. We have also the luxury of benefiting from Srinath, who will moderate the panel a bit later during this session, where you will be able to raise your questions. So please do raise your questions via the chat. You see two pop-up screens potentially, one on the list of participants. We have now close to 80 participants. You see all the names, and you have the chat window when you can enter your comments, your questions. So we'll first focus on the documentary trade operations, so more the origination focused issues, and then we'll focus on the liquidity issues, liquidity and how the government relief efforts can be connected to the trade asset class in order to allocate those efforts to particular receivables and payables. So focus on origination first, and then focus on distribution. I believe those two topics are where the recent technology developments are not as widespread known as others we have been talking about in the past, such as electronic bills of lading, and the regulator we know has already taken some action. So this is why we're focused on those particular additional innovations where regulatory intervention is can still definitely make a difference. I will now hand over to Sean, who will introduce us ITFA and the ITFA FinTech committee with the next two slides. Sean, over to you.
Thank you, Andre, and thank you to everybody in the Indian subcontinent for joining us. I hope you'll see at the end of this the ways in which ITFA gets involved and really is trying to be a big driver in changing technology, in starting the debate and moving on to the debate about regulatory and legal change. So, few words about ITFA first. We were founded in 1999 with only something like 15 members. We're now nearly 300 members globally, and that's very important because the ITFA community, excuse me, is not just based in one region or one continent. We have most of the Asian banks as members. We have added very recently a very big American chapter. We have a lot of banks in Europe, of course. And more than the breadth of the membership is the breadth of the type of the members that we have. So you'll see on this slide here that really we started out with essentially banks and forfeiting houses in 1999. We've expanded to a number of different risk origination and distribution products. But the breadth really of the members that we have, which adds to the richness of our community, is set out here. So from the transaction banks, from the commercial banks, from the big and the small, my own Sumitomo, one of the world's global banks, and indeed all the world's global banks are members, but a lot of the much smaller ones as well. So we have originators and institutional funders and asset managers are a much newer class. Law firms as well, adding and other consultants adding their bit. But really importantly, I think for today are the insurance companies and the brokers. They've become an extremely active community. We have been lobbying a lot in Brussels to change the law there. We are working in the US as well. And of course, today, most relevant are the FinTech members, which Andre chairs the committee of. Now, that's around 25 members, and it really does cover the whole spectrum of FinTech companies. So, and here they are. So one of the things that's really important when you look at FinTech for trade finance is to realize it's not one thing, and it's not, generally speaking, one provider that can do everything for you. There are a lot of specialists, starting obviously from the pure tech providers, the people who provide the like Finastra, who will provide you the software, and then we move on to some of the more specialized services dealing with data, such as Intix. We move on to the platforms and the specialist providers. So people such as Bolero and SDocs, of course, are providing very specifically focused services, which are very important for trade. And all of these sort of fit into this sort of FinTech soup. But we cover, I think, but it's very important when you are a member looking to see what you can do with FinTechs, to have an idea of the whole picture. So this is what we have managed to do, thanks to the type of members we have. So it's really covering the A to Z of FinTech.
Thank you, Sean. Thank you, Sean. We going to look at two topics, as I said, the issues in origination around trade operations, and the suggestion how to use technology in the liquidity space, in the secondary market space. There is a third topic we could talk about, but we left it out for the moment for this session. It's all about alternative lenders. So we'll exclude that from this session. But here, basically, if we map the FinTechs we have in our committee and the latest, really the very recent technologies that could help or that can help address some of your issues. In terms of mapping, we see the following ones: TradeStream, Intix, and Enigio are the three ones we're going to cover quickly today to address some of the pain points you have following COVID-19, and TradeTech for the second topic. So this is why you're going to hear more about those technologies in the coming slides. So moving on to the first topic of operations and moving to paperless trade finance, what is possible in addition to what is well known, such as digitizing electronic bills of lading. And I will hand over again to Sean to explain us from a policy decisions what is happening and what still needs to happen.
Yes, so thank you, Andre. So as I mentioned, there are a lot of moving parts when you choose to set up a digital operation, and a lot of different things that you need to think about in the wider world. So recently, of course, in the last month or so since the lockdown, there's been a huge emphasis and focus on e-signatures, and that's all about getting the deals that you had in the pipeline today or yesterday done. and with people not being in the offices, having variable access to scanners and printers, not being able to sign documents in the traditional way, they've had to find alternatives. I'll just mention here a paper that ITFA has worked on with ICC and BAFT, which was released, or will be released through ITFA this morning. And this is what we sort of digital hacks paper. A lot of that focuses on, in other words, quick digital solutions using existing technology. And there's quite a bit in there on e-signatures, because that has had to move very fast. But we need to think a little bit also about the the near future and slightly more long-term future. So as I explained, and we reflect this in our FinTech community, you have to have a really holistic picture of what technology does for you and what it needs. And part of that, of course, is around making sure that you marry up the physical part of trade, and that's what we'll concentrate quite a lot on when Alex talks about e-bills of lading. But the financing counterpart of that is the second initiative that we have going on here, the digital negotiable instruments. We have released a paper that's available to members through our website around how these can be digitalized. Now, as Andre has said, and it's to my shame because my day job is as a lawyer, that the problems here have been largely legal problems. So the technology is there, to my point about what you can do today and next week, but some of the legal problems that we've had have been difficult to overcome in the very short term, and most of these, in fact, have still not been overcome. We're moving very fast, and if there's one good thing about COVID-19 is that everybody, governments, trade associations, banks, everybody is focusing on how we can now move the needle much more quickly. That paper that we've released shows some interim solutions to the problems, how you can effectively create functional equivalents of bills of exchange and promissory notes in a digital electronic form, which are legally valid and are the equivalent of the instruments that would exist if we had proper if the statutory law here had moved to recognise them. So we found an equivalent. So you'll see when you read the paper what I mean about that. We do need to change the law, but in the meantime, we've come up with a pretty robust interim solution. Now, Andre has mentioned rules and the work that we do with the ICC and also the WTO. Trade obviously is global, and part of the issue is that if we change the law in one country or we change policy in one country, for that to work really effectively for global trade, we need to make sure that that happens everywhere, or at least in the important countries for trade. So at WTO, I've had the pleasure of going down there on several occasions, that we have looked on that as a very good entry point to influencing change at really a global level. And this is through the drafting of things like free trade agreements, which are, and some of these that you will have heard of are regional, of course, but some are simply bilateral. Of course, famously, the UK is currently negotiating a lot of these bilateral treaties because of Brexit. So been down several times down to Geneva to talk to the WTO about what's necessary. And because this is global, some of the problems that we have, some of the problems rather that we don't have in, say, Western Europe, do exist in other countries. And these can be simple things like not just the electronic signature, but actually, can you have even a document in electronic form? So is e-writing at a very basic level, is that effective? The ICC are really important here as well in the rules, because a lot of what we do is contractual, is contract-based, is contractual. So, of course, we all know the UCP, but there is also the EUCP, and that's in fact been drafted into a second edition. There's quite a lot of discussion around that in the paper I've mentioned, but that is getting a lot of attention from banks. This allows you, of course, we've issued the letter of credit itself through SWIFT, so it's been digital or electronic for a long time. But the EUCP now deals with how we can process, accept, and review electronic documents. Part of that, of course, as well, and this is one of the advantages, I think, of digitization, of putting everything onto one or a small number of platforms, is that you can also digitize a lot of the less pleasant tasks that us bankers have to do. So KYC, AML, due diligence, checking, that is all much simpler when it's plugged into a platform. Of course, there are specialist providers who will provide the actual service. But the important thing, I think, to retain here is that these are things that are plugged in to your electronic setup, your digital setup. And so the processing is much smoother, much more streamlined, much faster, and much more effective. The last point here, I think, goes back to the issue we've raised around global trade. So often the weak point here, and it is a sort of weakest link phenomenon that we often have to face up to, is that ports and customs often require paper originals. And that can be bills of lading or phytosanitary certificates, certificates of origin, and so on. So in the current crisis, there has been admirable movement by a number of governments. I'm pleased to say that India is one of them, towards moving away from paper originals to having these in digital form. So it's important that all of the documents, of course, some of the documents, invoices and so on, have been digital, electronic for some time, but all of those sort of official documents as well, that each and every one of them becomes electronic. So these are all the different spaces that we're playing in, all the different issues that we're trying to hit through a number of different channels. ITFA is playing a very big role here. Our e-signatures paper, which again you can find on our website, and that's available also to non-members, had an enormous take up. But now we need to move on and think about the next stage and about really digitizing the whole of trade. So Andre, thank you. We'll move on to the next slide.
Thank you, Sean. Indeed, some regulatory decisions have advanced at global level or national level, but many others are still pending. So let's hear indeed from Alex, representing ICC, what has been going on. A lot has been going on. And there was another paper recently, I saw yesterday. Alex, can you tell us more?
If I can get off mute, I will try. Yes. So about 3 years ago, the ICC set up, or the Banking Commission set up, a digitization working group. Originally, we had 3 prongs. One was to update the ICC rules. And Sean mentioned that last year we published the EUCP 2.0 and the first ever edition of the EURC to allow for documentations under doc collections. The second prong was a legal work group that Sean headed up, actually, that wanted to look at global acceptability of electronic bills of lading, because as Sean mentioned, the legal status of title documents on a global basis essentially is behind where it should be, behind where we need it to be, and it's a very patchwork problem in the sense that, for example, the US fully allows electronic bills of lading, whereas a country like Germany actually has legislation that says electronic bills of lading are illegal, to go to the 2 extremes. So essentially the legal work group went out and did an analysis of 10 or so countries to understand where the status is. And the conclusion of that is more work is required. The third group was then focusing on, well, we've now expanded the ICC's work quite significantly. So we just launched a group to allow for AI, understanding how AI should be standardized in the back office in terms of facilitating automation of compliance checks trade-based money laundering checks, and documentation, document versus LC checks. Obviously, there's been a big push and a lot of work that's gone on in that space. A number of vendors have come up with solutions that are increasingly widely adopted. So the question was, how can the ICC help in ensuring that as this technology is implemented, it's implemented in a consistent fashion across banks and across the globe? We have a communications group that is focusing very heavily on assisting people understand what is going on in digitization and pushing for example, changes in legislation. And really, when Andre talks about the various work that we've done in the last few months, a lot of that has been around education. So the ICC has launched a plethora of information, probably literally in the last 4 weeks. We've had weekly calls, probably now for 2 months, on COVID-19, understanding the impact across the globe, understanding the status with respect to force majeure and where force majeure is being claimed versus whether or not it should be claimed. So essentially the key highlights of our work, as Sean mentioned, I think we published last night this guidance paper, which essentially focuses on hacks. What are people doing today to allow their business to continue to operate despite the fact that legally they don't have perfect solutions? Scanning email signatures. So these are real world examples of what other banks are doing, to share with you some ideas and some thoughts as to how you can address the same problems. We also wrote a paper very specifically asking governments to step up and start to make the changes required to facilitate paperless trade, whether that is changes to the legislation, whether that's changes to regulation, or whether that's changes to practice. So both Sean and Andre have mentioned that you have issues with bills of lading in ports. Very often, that is much more an issue of practice than of law. So we do, or we see, as you would expect, lots of bills of lading, electronic bills of lading going into China under all sorts of modes. The Chinese government 18 months ago at HQ level of customs went out and said, scanned copies of bills of lading is acceptable for customs clearance, which means any electronic bill that can spit out a copy should be acceptable into China, in theory, based on that advice from Beijing. What we see is that's often the case, but in some ports you go to, from practice, from experience, customs officers, or potentially customs brokers are still asking for paper originals. And unlearning, as we all know, takes a lot longer than to learn. And so a large part of this is helping people unlearn. So the guidance paper that we sent out yesterday is how do you solve this problem immediately, or how can you help solve this problem immediately? We're now working on a next step. So the ICC launched last year a roadmap, and the roadmap was focused on governments, or was a roadmap for governments to understand what changes were required to facilitate paperless trade, whether they be legislative, procedural, infrastructural. But we now need to get to the next level, which is to focus on different countries and what they need to do. So for example, in the UK, we do not actually need to change. We do not need a new act of parliament to allow for electronic bills of lading. There is a provision already in UK COGSA that would allow for a statutory instrument to be issued that would facilitate or would recognize electronic bills of lading. So the next level of advice the ICC wants to come down to is helping people on a regional and even a country level focus on specifically what is required to facilitate electronic bills of lading, electronic bills of exchange, electronic promissory notes, etc. Now, our primary advice as the ICC has been and remains to be invoking the UNCITRAL model law on electronic transferable records, because that model law by itself would capture all 4 negotiable documents but we recognize that that will take time. Singapore tends to be a country that puts itself forward as being very advanced and being very fast in moving towards digital and promoting anything that assists Singapore remain a trading hub. And even for them, it will take them 3 years to implement that law, or at least that was the timetable pre-COVID-19. So the question is, will these timetables be accelerated? Possibly, but more importantly, we need to find faster methodologies to allow for this transfer of legislation, regulation, and practice. So that's really what the ICC has been working on. We hope you find it helpful. If you have any thoughts on what else we should be publishing and what else we can publish, there's so much information coming out today. We're also cognizant that we don't want to overwhelm people with information. But we're certainly doing our best. And I think from the ICC, the amount of publications we've issued in the last month is almost miraculous if you look at the bureaucracy of the ICC. So it's only thanks to ICC members and member banks and individuals like Sean, who have been, if you excuse my language, working their butt off to make sure that we can help people get through this very difficult time.
Thank you, Alex. Exactly. We need to look at those documents, and we're happy to, if Pinaki agrees, we can share those very latest document. The last one that is not mentioned in this deck has been published yesterday evening by the ICC and is very specific, and that's what we need. But of course, not all depends on policymakers. There are many things you can do today in terms of leveraging available technologies. And in order to structure the debate here, we're still within the origination and paperless trade finance between banks and their clients and the FI counterparties. There are 3 areas where technologies enable you to move forward. And some of them do not depend on additional policy decisions, whilst others will. So we're going to look at technology options for digitizing trade back office operations, something you can do now. Using very recent capabilities with machine learning and AI. We're going to look at options to digitize the documents and those documents that are being exchanged between parties, supporting the communication, and reusing existing technologies in your back office and channels such as Swift. And of course, from those technology developments, we need to identify additional policy changes, and we need to engage more with the regulators. So if we do a mapping between the FinTechs we have within ITFA and those requirements, there are 3 FinTechs, as I said earlier, we want to focus on, and some indeed can be implemented right away without additional policy changes. So the first one we want to talk about is TradeStream, which is a member of ITFA since early 2019. And I will invite Jayan to tell us more about how TradeStream can help banks today. Jayan, can you unmute yourself?
Yeah, thank you. Thank you, Andre. Can we, yeah. So it is good morning, all of you. And it is indeed a pleasure to meet many of you with whom we have worked together in this webinar. Some of you who don't know me, I am a chartered accountant by qualification, but I consider myself and take pride to be a banker. I have spent more than 25 years in the banking industry, including ICICI Bank, Yes Bank, and in TCS, wherein we were processing and putting in technology for some of the large global banks. Since the last 3 or 4 years, we got together, we as senior bankers, some of us got together on account of our frustration in the manual processing of trade and the lack of digitization and automation. And we also found the opportunity in the advances which were happening in the natural language processing arena as well as in the machine learning. That brought us into founding TradeStream, and I am currently in TradeStream working as the country head, wherein we have got the Center of Excellence as well as offices in Bombay and Calcutta. So that's a brief about me. Now for coming to the topic as in today, The world is indeed in a crisis. There is no denying the fact that the world is indeed in a crisis. It is very sad that we are seeing people losing their near and dear ones, and some of them dying without medical care, and some of them dying all alone in the hospitals. Having said that, while it is a crisis, it is also that we should not allow this crisis to go waste. There is always an opportunity which one sees in a crisis. The world trade is expected to go down. That is indeed anybody's guess. Likewise, the GDP is expected to go down. But I feel I'm an eternal optimist, and I would feel that there is an opportunity which is hidden in this downturn. I feel that there would be a new world which would differentiate in the way we live, commute, work, as well as consume. Trade finance being no exception, trade processing being no exception. It would not be the same, and if it remains the same, I think the banks and the corporates, etc., who would continue to process the way in which they are doing, they would have a tough task ahead. Andre, can we go to the next slide, please? Yeah, I have been speaking to my banking friends as well as to my friends in the ports as well as the customs. What they tell me is in the ports and the customs, there have not been many issues as far as clearance of the goods are concerned. The goods are moving, the trade is down, but the goods are moving. There is also a movement of non-essential goods in India, even though there is a lockdown. But the banks and corporates have found it extremely difficult in two areas. Primarily, the movement of the documents, and the second is getting the skilled people to process these transactions. Even if the skilled people to process the transaction, the third difficulty which the banks have been facing today is how do they access their systems and platforms remotely. While the people are willing to work from home, since there is no public transport which is available, but the accessibility to their platforms and systems is indeed becoming difficult. These are the two primary issues which the banks have been facing in this current scenario. Having said that, the banks would somehow manage this process. The customers would also be more forgiving during this time. But having said that, I feel that the challenges would be post the lockdown. Trade would definitely be lower to begin with, but the margins and cost would be under intense pressure for the banks. The proportion of LC transaction which have been showing a diminishing trend in the earlier years, with the current geopolitical situations which is there, I would feel that the LC transaction will now show an increase. One of the reasons also being that the people are not able to visit different countries in order to assess the buyer or the seller. And lastly, the higher level of compliance for trade amongst countries would be a norm. Again, because of geopolitical situations, and also because banks would now want to, or corporates would now want to depend upon more on the documentation and the information that is available rather than on physical checking of the goods or physical verification of the buyer or the seller. Can we go to the next slide, please? So post the COVID in the new world, what according to us, which are the banks which would thrive, and which are the banks which would have major challenges? We feel that the banks and corporates which are nimble-footed and which are not only able to process transactions but also to move documents seamlessly are the banks which the corporates or the customers would want to move to. They want to see that the documents are moved seamlessly in a secure and timely manner. The second is the banks which are able to process transactions under any eventuality. Customers would want that the banks should be able to process transactions 24/7 by 365. They would be unwilling to wait, and particularly with this scenario, they would definitely be looking at banks as partners who will be able to process transactions irrespective of what happens. The scenario wherein we used to build in our banks a BCP, a disaster recovery scenario, would now be a thing of the past, because customers would insist that the documents have to be processed irrespective of whatever is the situation. Third is banks that are able to optimize cost. All of us as bankers know the fees that most of the bankers charge is either very negligible or it is almost zero for the customers. The banks which are able to, the customers would now pressurize the banks for reduction in cost significantly post the COVID scenario. The banks which are able to optimize the cost are the banks which would be able to come up trumps in the post scenario. In such a situation, most of the banks would look at moving from a fixed cost to a variable cost scenario. That would give them the flexibility for having the price to be elastic depending upon the volume of transactions which they would have. A fixed price scenario makes the prices very, very inelastic for the banks, and thereby banks would want to move to a scenario wherein the pricing is very, very elastic, or it would depend upon the volume of transaction. And lastly, there would be very, very less tolerance for inaccuracies in the processing, for inaccuracies in the compliance. Even one compliance hit or some issues in the processing, because banks would be working on wafer thin margins, the customers would also be working on low ticket transactions. The tolerance which they would have for compliance related issues or for some money getting held up would be extremely low. So we feel that this is what would differentiate the successful banks with the not so successful banks. And as I said, we in TradeStream have been working since the last 3 to 4 years on a solution because our frustration on manual processing and the lack of automation. We've been speaking to the banks during this COVID scenario, and it seems from their talks, it is not what we said. It seems to be the medicine which the solution that we were putting in seems to be the medicine which the doctor prescribed. We were working on 2 major initiatives. One is TradeShare, which is a platform for sharing of documents in a secured manner, and TradeServe, which is a platform for processing of the transactions for banks. So this seems to take care of both the major issues with the banks and corporates are facing during this COVID scenario. So I'll just give you a brief of what TradeServe and TradeShare is. TradeServe is basically a cloud-based platform. It uses machine learning and artificial intelligence in a very big manner in order to digitize and automate the entire trade processing. So the principle is, first we digitize those documents through OCR and machine learning to begin with. Then we run the rules based on it. That is, we automate the entire trade processing by running rules, which are again based on natural language processing as well as machine learning, which is there. The third is we run the compliance on those documents, again based on rules, etc. The compliance would be UCPTC guidelines, RBI guidelines, the bank's guidelines, the dual use good guidelines, or even the vessel checks and container checks which would be there. And the last is, it is how do we ensure that there is a push of the transaction being processed through graphic user interface, through the MIS data reporting and business analytics. So there is a lot of granular data which is available, which helps in business analytics and for the banks to get insights on their customers as well as on the customer's importer exporter. So that's basically TradeServe. And TradeShare is a platform which helps the banks and the corporates to share documents in a secured manner. There can be multiple parties to a trade transaction. We use distributed ledger technology for this purpose. Each party can provide inputs. There are status updates which happen, and the privileges can also be set. So if I may, for TradeShare, our principles, the 3 underlying principles on which we have put it is basically the trust. That is, it is based on trust, that we identify the parties and we ensure that the parties are securely connected. Because it is secure through encryption, it is a non-repudiation of the contract or whatever are the transactions being done on this platform. And the third is transparency, wherein each party is able to view as to in what stage the transaction is, whether it is the importer, exporter, the advising bank, or the negotiating bank. So these are the 3 principles on which TradeShare has been built in. So to begin with, if I may summarize, the TradeShare is one which a corporate would start off with, wherein it would start off with exchanging these documents between its bankers and its buyer or seller. TradeServe is a platform which the bank would start off with for processing transactions for themselves. However, this trade share can also be used by the corporates before they send the documents across to the bank. Some of the differentiators which we have, as I said, it is in the cloud 24/7, 365. One of the primary things is the data is stored in India. Amazon Web Server, on which we are currently based, it allows data to be stored in India. So some of the issues regarding data being taken out of India is taken care of. There are more than 275,000 rules in the platform. One thing which I would like to highlight, and which I am particularly proud of, is that up till now, with the banks and the corporates with whom we have worked out, there has not been a single case manual checker has found discrepancy and the system has not caught it. The platform has found a discrepancy, but the manual checker has not been able to find, but not a single case vice versa. And quick implementation, it's less than a week. And we've got a team, we pride ourselves as being bankers in the technology industry. We've got a team of people who are veterans in the banking industry.
Thank you, Jayan.
Yeah.
That was very good. In the interest of time, let's move on. I mean, that's really the goal of this session, is to map your specific issues as highlighted in the ICC papers, and certainly the last one that was issued yesterday, to the available technologies. And certainly in this particular case, the technology can help without the need for additional policy. If we win additional policy, that you will get more benefits from such technology, but most of the benefits can be reaped by banks and corporates without relying on additional policy decisions. Let's move on in the interest of time. Another ITFA member that I'd like just briefly to talk about is INTIX. On the INTIX side, this is all about accessing data, transaction data, mainly on the payment side. And as we worked with some of our clients during this crisis, they just increased the number of remote users accessing that platform, because the goal of the technology is to offer access to transactions that are being processed in production systems. And when you're working remotely from home, the security layers mean that you have less access to internal systems, just to protect those internal transaction processing systems, like the core banking system processing payments, for instance. And with such technology, you have a layer that gives you access to the data, not to change it, but to consult it. And basically, this is what we heard from some of the clients of INTIX, is that they have upgraded the number of users because of the fact that most of the teams were indeed working from home, and the access to the data was becoming critical. So that's another example of very specific technology that is addressing a data accessibility issue. It can do much more in terms of business activity monitoring, but in terms of accessing data remotely and whilst protecting internal systems, I thought this was an interesting one to share with you as well, given the client feedback that was collected during this COVID-19 period. Moving on, there is a third piece of technology and legal work that ITFA has been working on, also with one of the technology partners of ITFA that we will present. And I'd like Sean here to talk about this digital negotiable instrument initiative, which is complementing all the work, and certainly the work that an SDocs or Bolero are doing on e-bill of lading, or TradeStream is doing on the back office operations. So Sean, can you tell us more about this initiative?
Yes, of course. Thanks, Andre. So as I mentioned, there's a lot of moving parts to trade, and there's physical trade, which is what SDocs and Bolero are principally concerned with, but there's also obviously the finance of trade. And as banks, that's our main concern. I mean, obviously we want to have security and understanding of the underlying physical trade, but we need to process and offer the finance for that trade as efficiently as possible. Now, in many parts of the world, and especially in India and a lot of Asia, negotiable instruments have been very popular for a long time. They have been part of the law merchant for literally centuries, maybe even millennia, actually. In the Commonwealth, of course, the act that I'm sure many of you are familiar with is the 1882 Bills of Exchange Act. And that has been the model really for a lot of the Commonwealth countries, the ex-colonial countries. So India, Pakistan, and so on will all have acts, statutes that are based on this. And the problem we found, and I've mentioned it earlier on, is that the law has not really kept up with the changes in technology, and that's the reason why actually the use of bills of exchange and promissory notes has not fallen off a cliff, but has really decreased quite considerably. Less so in some countries, but really quite considerably when you look at regions like Europe. And the reason for that is that they are very cumbersome. They can be lost. They have to be couriered. So there's an extra expense. If your office burns down, then you've lost your financing title, and that's not very convenient. It's also very slow and therefore very intensive in terms of human processing. So again, I'll say the technology is ahead of the game here already. In relation, though, to digital negotiable instruments, the solution is slightly more recent, and within it, we have been working with a couple of companies that have provided this. And because this is a very important part of what we do in ITFA, we've put our weight behind an exploration of the issues. So as I mentioned before, really our DNA in ITFA is to try and find solutions that work today, whilst trying to improve the landscape and the environment in the medium to longer term. So the paper that I've mentioned before, it's also referred to in the paper, in the ICC paper, which was drafted with ITFA and with BAT, explains first of all what the problems are, but comes up with a solution. We've also been lobbying the UK government, and you'll see there attached in that paper, there's some correspondence with the Ministry of Justice. There is a lot of steam, or a real headwind, tailwind behind this, because the government in the UK realises that this is a really important thing that they could do that's going to influence trade globally. So English law governed instruments of this type are used globally, and I've also mentioned the fact that the Commonwealth has legal systems that are based very much on English law, and a change in English law, of course, will be a flag to them to go ahead and do the same thing. So Alex has mentioned earlier on that there are some countries, such as Singapore, that go very much faster than others, but even they have not managed to deal with this yet. So we think now, and there's very encouraging signs that there's real interest in getting this done quickly. The real impetus for this actually before COVID-19 was Brexit, again, and from my point of view, not a really good thing that's had at least one beneficial consequence. Now the driver and the impetus is the need to deal with the consequences and the fallout of the pandemic. So we're working on that very hard, but in the meantime, read that paper, because there is a solution, a practical solution that works today.
Thank you, Sean. Indeed, that has been developed on the basis of document technology that is offered by yet another ITFA FinTech member, Negotiable. I suggest indeed, and I got some requests already by email, that we do follow up with the delivery of the documents we have mentioned, whether we're talking about the ICC paper that was issued yesterday, or the DNI, the Digital Negotiable Instrument Initiative papers that we released yesterday as well. So we'll get you more information certainly post this session. Again, I want to emphasize that those different technologies we are introducing today are matching short-term or existing issues, matching urgent needs, and in some cases they do not require policy decisions, but in other cases, depending on the countries or the use case, they do require. But focus is indeed on making sure that some of those solutions are implementable today to address some of your challenges. And that's exactly the thinking we have here in terms of matching those technologies to your operational challenges and talking to regulators to highlight that we can increase the technology adoption and the benefits from technology if the policymakers change some of the laws. This is closing the first part of this session. I think Alex had a question for Sean at this stage before we move on.
I did. Sean, what countries do you think the solution that you're proposing for essentially electronic bills of exchange, what countries could that work in immediately?
Well, the immediate change, if we secure it in the UK, and as you mentioned earlier on, Alex, there's a longer way to do this and there's a much shorter way. You've mentioned on the COGSA, the Carriage of Goods by Sea Act, how the law could change relatively quickly for bills of lading. There is a similar route. It's a different statute. There's a similar route for negotiable instruments under the Electronic Communications Act, which could be used to change the Bills of Exchange Act. So if we manage to do that, I think where this would have an impact, firstly, I think it's a very important point you mentioned about the fact that the problem very often is not the law, but the practice. Where there is a document that is subject to English law and it's just been practiced locally to require that in paper form, the fact that English law will have changed by that point to allow for digital versions of these means that the practice is probably likely to be easier. But to answer your question directly, where is it most likely to be taken up the quickest? That will be, I think, the Commonwealth countries that traditionally have looked to the UK for how to model their laws. So these will be countries like, for example, Australia, New Zealand, and India, and a lot of the Indian subcontinent. So there is, I think that's where this ripple effect will hit first. So I think it's good news for India in that this will be, I think, a good case study for Indian legislators to take up. Hope that answers your question.
Thank you. We'll have more questions during the panel. Moving on, I want now to move to the secondary space, the distribution space. ITFA has a specific initiative there also to promote trade as an asset class, to attract additional investors into our business, mainly capital markets funders. So I'd like to introduce the second part, focusing on allocating on the liquidity issue, allocating government relief efforts in a targeted way by applying those relief efforts to payables and receivables. For this initiative on the trade finance distribution, we are working on the ITFA side with TradeTech, and I'd like to introduce Christoph Gugelmann, CEO of TradeTech and member of the TFD initiative. Christoph will introduce us with the proposal of a technology-based market practice to address the liquidity issues. Christoph, over to you.
Thank you so much, Andre. As you probably know, there is many countries in the world which have been able to implement successfully loan programs in order to help the economy. That's, of course, kind of like beside many other measurements which have been implemented. Loan programs are good programs. They are kind of based on existing established allocation operational processes, and they do help companies best where companies cannot perform. So if you take the example of a grounded kind of like airline company, then essentially that means that they cannot fly, and therefore there's nothing that they could do in order to perform. So that's where loans really can be very helpful. They're usually one-off supports. So a corporate applies to a local bank. Local bank turns around and gets kind of a support, a guarantee from one of the government supporting entities. There are some challenges with these programs, and they, of course, involve that it increases the corporate's leverage ratio, and that will add further pressure on the balance on the corporate itself. It also can lead to wrong allocations. Companies which might need cash but might not that desperately need cash might still be inclined to take the government up on the proposition and hoard cash. So what we think and what we have been pushing for, and with some success in some regions and still limited success in other regions, is to include trade finance into these programs. Trade finance is really critical to keep supply chains moving. And what it does allow is it allows to provide funding in a very targeted way where it's needed most. The government can reallocate those funding on an ongoing basis and review it. And if it turns out that in certain parts of the corporate network, less funding is required, well, then it can be shifted to some other area. It does not increase corporate leverage if instruments are getting sold into a government-sponsored program. And as such, it's a fantastic way to really make most use of an existing program. So maybe move to the next page to give you an illustration. It's a fairly complicated page, but it comes basically in two flavors. From right to left, what you will see is it's the corporate customer of a bank. For example, let's take a supplier. He knocks on the door of his bank. The bank basically now can turn around, and knowing that they can sell some of the exposure the supplier wants to get funded, it's able to sell receivable instruments, for example, into a trade finance purchasing entity, which is kind of sponsored by the government, and then from there, that trade finance purchasing entity is able to issue notes and sell these notes to a government support entity. Many countries have these support entities. In Italy, it's SACE. In the UK, it's the British Business Bank. In Germany, it's KfW, and so on. And these entities have been really flushed with now cash, but also abilities to provide support. So they're already there. We don't have to invent anything new. The only thing we would do is enlarge kind of the scope of these programs to also include trade finance. And in many cases, the non-inclusion of trade finance is unintentional. We have done some work around the UK, and it turned out that certain type of instruments were just unintentionally not kind of like included, but with no real reason, and of course then to the detriment of the banks, which couldn't really then use these trade finance or fund these trade finance instruments. So on the top part of this chart, it's everything done on a funded basis. That means the bank now sells these instruments into a purchasing entity. Purchasing entity issues notes, and the government purchases against cash these notes. That's of course not necessarily the preferred solution for government. Usually the government guarantee programs are much larger than the cash programs, and hence the kind of like the lower part, option 2, does exactly the same, just with the difference that the government is only supporting through a guarantee, the purchasing compartment, and then these kind of guaranteed notes will now be sold to capital markets, and therefore they are placeable anywhere. So maybe if we move to the next page, we can see why that funded or unfunded support solution is actually a good solution for all parties involved. On the one hand side, you have the government entity. They are now able to really target in a corporate network the deployment of the funds where they are most needed. And as you probably appreciate, is corporates are not just kind of like companies which have a financial strength right now in a fully isolated basis. They are completely dependent on the network they live in. It's the sum of the payables and receivables they have on their balance sheet, which really drives the success of the corporate. And as soon as there are disruptions coming from a first, second, or third order degree, well, you will see where the shock is traveling from. And what we now can do is we can identify those shocks. We can look at where the shock is coming from, and that's where the government can target the support the most. So every single deployment of funds can now be recycled several times a year. That's different, of course, to longer term loan programs where you deploy them once, and they can be daily monitored, and we can actually see where the impact is the best. For the banks, it's fairly straightforward. What they will do is they will sell the instruments, invoices, receivables, whatever qualifies under the respective program, and will then also get rid of them in a way from their balance sheet, which makes it attractive to them as well, to now originate more in order to distribute, and not kind of like accumulating more risk on the balance sheet. They will make a servicing fee for their classical origination role, which they assume, which is of course collection, workout, the AML, KYC processes, and so on. And the technology is available to do this in a very automated, very granular way between the bank and the government entity, whether that's on an unfunded, funded basis, whether there is an SPV in the middle, as we have seen in the page before, or not. Most importantly for the corporates do not increase their financial debt ratio. I think that's critical. This crisis will come to an end, and corporates will have to basically be able to be competitive and be able to go to markets again, and the more pressure we put on them, the worse it is. So not increasing the financial debt ratio, I think, is probably the decisive point here. And it, of course, kind of keeping the supply chains alive. That means they can keep performing and can be also able to pay their salaries. Maybe moving to the next page, the call to action. I think I said it before, and we had a dedicated call on this very recently, and I think it's very important for policymakers to really rethink, kind of, is trade finance, should it be included into these existing programs? Just for completeness, there are 3 areas, and in order to support trade finance, which have been discussed over the last few weeks since we had this first call. Number 1, it's really, how can I support private insurance companies? How can I enlarge existing export credit agency programs in order to maybe not just include certain countries, but maybe include even my neighbor countries into this program, which would have never been included before. And then thirdly, what we just have proposed, to have a dedicated kind of trade finance support program in line with what we have seen before. Then the next page will show you quickly how technology can support here. I think the industry trend, with or without COVID, is one where the pressure on banks to move to an originate and distribute model is only increasing. And the new Basel IV rules, or the last phase of the Basel III rules, will once again increase the need to hold more capital against trade finance instruments. It comes, of course, through the global output floor, through the new risk-based system where advanced IRB approach is no longer admissible for certain type of trade finance, for certain type of banks where, of course, were relevant. And that puts more pressure to distribute, and the solution here is really to transform the assets in order to create a capital market ready product, or a product which can be absorbed by a government entity where it has to be a government entity. We can run the portfolio management. That means we can provide real-time insights on every single invoice which goes through the system, where it is and how it fits into the corporate network, where we observe a network. And we can also provide some credit scoring such that we can identify where also help is needed the most. I think I leave it with this.
Thank you, Christoph. This is another example of an ITFA FinTech that is focusing on the specific segment, the secondary space, and focusing here on addressing COVID-19 related issues by introducing technology-based market practices. Here, the policy action is awareness. How can policymakers understand that the trade assets are basically offer a channel to apply their funded and unfunded relief efforts to the benefit of the end corporates, whilst respecting the bank to corporate relationship and not touching that relationship and how it is operated at all. So Christoph mentioned an important keyword about the non-intended fact that trade was not considered, or some trade instruments were not considered as part of the government relief efforts. And this is basically where we need to action at domestic level to make sure regulators understand the opportunities that are brought to you by ITFA through this technology-based market practice. So this ends our second part. And with this, very glad to share with you that we are very good on timing. So thanks to all of you speakers who have been sharing your expertise and presenting those technology-based solutions. I would like now to hand over to Srinath, who will take us through the panel discussion. And I think we already have quite some good input on the chat that we can use during this panel. Srinath, over to you.
Thank you, Andre. Good morning to all. This is Srinath speaking from Singapore. For the few, or for the many who might not be acquainted with me, I engage in training and consulting for financial institutions through trade risk consulting. And I'm also associated with the FinTech initiative, which happens to be a member of ITFA, which is Trade Assets, a portal to an online marketplace where banks meet to exchange trade risk. Now, for this part of the program, we're of course very conscious of the time available to us, and we'd like to pack in as much as we possibly can. So what we've done is that we've in advance spoken to a few of the listeners. We've spoken to a few of the listeners who are participating in this program, and I've kept them ready to answer some of these questions. So let me get started right away. I'm starting with Mr. Abin Daya. Mr. Daya, are you available? If you could please unmute yourself.
Yeah, hi Srinath.
Great. So if you could perhaps tackle the first question, which is what did the Indian policymakers enable so far?
Yeah. Srinath. So, see, India already had a trade digitization initiative running for some time, because of which bulk of the EXIM and exchange control processes had already gone paperless. We had already stopped issuing shipping bills and bill of entry in physical form, etc., etc. And to be very honest, this has enabled paperless trade offering that a few banks had started offering from 2018-19 onwards. The other part is that TREDS, it has been a critical enabler in facilitating paperless supply chain finance to small and medium corporates. And again, here the policy initiative is the Payments and Settlements Act, which provides legal or which equalizes legal mandate for electronic settlements similar to paper-based settlements. And this has been a critical policy enabler. So from a paperless trade finance perspective, a few things have already been done, but there still needs to be more policy interventions for electronic transport documents, resolving issues of stamp duty, etc., etc. Again, most of these are still a work in progress, which have seen heightened action now. Customs, in fact, last week has implemented processes which make customs clearances for import documents much more paperless. Some of the documentation, paper originals which were earlier required. The other thing we also need to see is how the capabilities of TREDS can be used to facilitate cross-border transactions, which again needs policy support from the government. So on the digital front, as I said, some measures have already been implemented. What has happened during COVID-19 period is that, as Sean mentioned, there has been good amount of policy focus on those parts currently work in progress, and hopefully see results soon. Specific to the liquidity and cash flow impact, while RBI has provided relief to exporters by extending the time period for realization and repatriation, it's also given a moratorium of 3 months on loan repayments, which has eased the liquidity pressure on businesses. And to some extent, again, anticipating the need for increased demand in working capital, margin requirements have been relaxed so that lenders can advance additional funding for businesses. Also, for banks, there is a relaxation on asset classification norms for stressed or non-performing assets. Again, realization is that there will be stress on liquidity and will feel the pressure on cash flows. One of the other things that has also happened on policy perspective is the decision to continue the 2% interest subsidy and 3% prompt repayment incentive for farmer loans during this period. Apart from all this, there are also efforts to infuse additional liquidity in the markets by conducting special open market operations so that requirements are met. Objective is that to ensure survival of even at the cost of higher inflation, which can be managed better. So these are some of the things that have happened. Hopefully, we will see more measures as the economic impact starts hitting us. That's from my side.
Thank you. Thank you, Mr. Daya. At 9 o'clock,
yeah, I can hear you.
In fact, Mr. Daya has just given us a good roundup of what's already taken place. From the extensive experience you've had in the Indian banking sector, would you be in a position to perhaps suggest what more needs to be done in terms of having a fintech-friendly policy framework that would make it easier for banks and institutions to adopt fintech solutions?
Yeah, thank you, Srinath. See, I was a member of the UK Sinha Committee on MSME financing, which was set up by the RBI last year. What we realized as a part of the committee's deliberations was that a lot of MSMEs are actually becoming sick only on account of delayed realization of receivables. And if something has to be done to save the MSMEs in India, so something on that front has to be done actually. There are a lot of suggestions which have been made in the committee, and work is going on some of them. I'll give you details of that a little later. See, first, if you look at how the trade financing happens in India actually. See, trade finance in India was always done by way of a cash credit limit which was given to the customers. The customers will typically give monthly a statement of their stocks and book debts. From the book debts, the banks will typically remove a margin and make available the balance amount as a drawing power, which the customers can continue to use. The problems with that system is that, one, there is no confirmation or no ability with the banks to confirm the genuineness of those trade receivables. Secondly, is that the banks will typically make available only less amount after reducing almost 20 to 40% from the principal amount. So which means that the full amount of bills that have been raised will not be available to the customers. So RBI actually had decided about 20 years back that a lot of this trade financing should move to bill financing. But somehow at that time, the banks did not like this idea. It never got implemented. About 5 years back from SBI side, we did try to again approach IBA as well as RBI to see that we can move trade financing from cash credit to bill financing or bill discounting. But again, somehow the banks were not really very enthusiastic about that. As Bin said, the trades have been a phenomenal success. There are 3 platforms that have been functioning very well. But after the COVID-19 problem started and the RBI announced a moratorium, I believe there has been an issue regarding whether moratorium is applicable to the bills that have already been discounted on the platforms or not. So there, I think the RBI and maybe the government need to clarify fast actually on whether this is applicable or not. Otherwise, I'm seeing that there are some defaults that have been happening there. But what we actually recommended as a part of the MSME committee was that there are certain limitations in the TREDS platform. One is that for any bill to be discounted on the platform, it had to be accepted by the buyer. And we found that a lot of large buyers, even though it was mandated that they must do all of their purchases by means of bills and they must accept the bills on the TREDS platform, there have been reluctance amongst the buyers to accept the bills on that. So can there be a second window of TREDS where the bills can be discounted even without the acceptance of the bills by the buyers? So that is, I think, the details of which are there in the committee's report also. Just to give you an idea how this is expected to work actually, and on which a lot of work has already been done actually. One is the GST platform has been working on something called IRN, that is the invoice reference numbers. Whenever any seller uploads any invoice on the GSTN platform, a IRN can be generated. And the moment that bill is accepted by the buyer, he can actually claim input credit on that. So that is the incentive that the GST platform will be offering to the buyers for the bills that have been routed on the platform. The moment that bill is accepted, it can actually move to another platform where the discounting can happen. For this, already an app is being developed. This will hopefully come as a part of India stack in the system. And then this can go to all the banks. Any bank can accept the bill. The difference here, of course, is that in case of the existing TREDS platform, the bills are accepted by the buyers. Here, the bills are not accepted. So the banks do take an additional risk. And this will be a with recourse financing. But we believe that in case this gets implemented, this can change the way entire trade financing happens in the domestic market. The IRN was supposed to be introduced by GSTN with effect from January this year. It got postponed to March, but now I am told that this has already been deferred to October 20. But in the meantime, a lot of work has already been done actually. I think the eBay bill is already in place. So this actually confirms that genuineness of whatever the underlying trade transactions have happened. On the e-sign and e-stamping, again, a lot of work is going on, and hopefully in the next few months, I think that even e-stamping of the bills should be possible. As you know that the Indian Stamp Act has already been changed. There is a move amongst all the states to standardize the stamps rates also. And this platform, if it is used for discounting of bills, it takes care of some of the KYC issues also, which were referred to earlier, because all the users would already be the customers of the banks for which the KYC would have already been done actually. Of course, the banks will have to build their own internal platforms to be able to make use of this. I guess if once this gets implemented in the domestic market, it can then be extended for the international trade also. A lot of steps have already been taken in the domestic market. I think Bin has already briefed about that. But I think the immediate requirement, of course, is this moratorium things need to be clarified on the TREDS platform. And again, I think the issue is on the reporting of frauds, reporting of defaults actually on the platforms. I think right now the banks only are required to report the defaults, but if the platform itself starts reporting the defaults, that could actually, be a further incentive for the sellers that, they can go ahead and discount the bills there. So that can take care of some of the issues which the sellers have been facing also.
Thank you for that, Mr. Gupta. In fact, we have a representative, Mr. Ketan Gaikwad, who might want to respond to some of the points you've raised. So I'm taking a slight detour. I was supposed to go to another speaker before this, but may I request Mr. Ketan Gaikwad to perhaps follow through on what Mr. Gupta has just mentioned, and also at the same time address the questions, that's number 4 and 5, which is what do you expect from your counterparties to drive their own adoption of digital solutions, and what more do you expect from the ITFA framework and FinTech initiatives that are in place? Mr. Gaikwad?
Yeah, thank you. Srinath, can you hear me?
Yes, I can hear you.
Yeah, so thank you for giving this opportunity, and I wanted to discuss the points which Mr. Gupta has raised. Some of the points are quite valid. First is thanks a lot to Abhin as well as Mr. Gupta to talk much about trades. You stole my thunder. So when you talk about the moratorium, see, look, trades is a fantastic initiative which the government is following up quickly and ensuring that the platform picks up, the participation on the platform picks up. So that's the reason why the government came out with various initiatives about corporates above 500 crores coming onto the platform, PSUs compulsorily enrolling on the platform and starting the transactions. In fact, if you ask me, the level of participation from the government is to such an extent that Prime Minister's office is following up on that particular extent. We got a call from the Prime Minister's office on Friday asking us how many PSUs have been enabled on the platform, how many are interacting. To state it correctly, that look, the PSUs and the corporates have initiated or rather registered on the platform, but they're not doing much of the business because they do not like the transparency on the platform, which is happening over here. And at the end of the day, look, when the transparency comes, a lot of things get taken care of on the platform. And this platform actually, when we have seen the rate of interest, when you talk about the SME funding on the platform, the rate of interest, the best rate of interest which you have seen is 6.1% for a large corporate, this is a rate of interest which is without recourse and without any collateral. Coming back to the piece of default, it's basically, look, this is unprecedented times, and COVID times are very unprecedented if you have not seen it. So there are bound to be defaults because there is a supply chain ecosystem disruption, absolutely. So in fact, before the RBI came out with the guidelines, we had actually approached the government, especially the ministry, finance ministry, the MSME ministry and the RBI. So we made a representation, and I'm telling you that, look, within 1 hour, I got a call from the additional secretary at the MSME and the finance secretary asking me detailed about what are the points you've raised and what are the things, we can do. And subsequently, the RBI came on the moratorium, and as usual, it was not absolutely clear from the RBI side on what exactly the moratorium applies for. Because RBI was very clear that this moratorium is applicable for term loans, and it is applicable for working capital loans, and working capital loans in the term in the type of cash credits and OD. So there's a whole lot of confusion over there. So we have actually written to RBI and to clarify over here to Mr. Gupta specifically that the clarity is coming in shape of the circular, which we expect in another 2 or 3 days. We made a representation, the SNP chairman also made a representation look, these are unprecedented times and you need to give times to the buyers to make the payment. If you look at the way the RBI has given this moratorium, if you have given a moratorium for a credit card payments, individual credit card payments, credit is also like a credit card. I mean, my logic is simple over here that look, on a credit card, you allow a retail buyer to go and buy the goods and give a credit period to the buyer. The same way you've given an extended moratorium for that particular piece of retail business. So why not a corporate for a corporate? It's a credit card which has been given to the corporate that you make the payment to the MSME supplier now and take the payment after 45 days or make the payment after 180 days. And that's exactly the logic we've used to RBI, and RBI is working on it. And as a result of this, because look, it's very unfortunate that the defaults are happening. I would not say the default. These are the corporates who have asked for a moratorium. When the industry has been given a moratorium, And I feel it is natural that they have to be given a moratorium. So I would not agree with that statement that the defaults are happening. I would say that the disruption is causing the defaults and not the other way around. It is not a normal scenario where the defaults are happening. So that goes about saying, so look, the government's initiative is very much higher over here. Government is keen that this platform becomes successful, and we see, and we've been making representations. We've been talking to media. The media has been kind enough to give wide representation to TRED's platform. In fact, today's newspaper, also an ET, carries an editorial which says very clearly that the corporates have to come on the platform and they have to start transacting on the platform. And that's precisely the reason, because look, in these unprecedented times, if the government has a deficit, if the government gives a opportunity, or rather forces the PSUs and the corporates to come on the platform, make the payment to the MSMEs, and then make the get an extended period for the credit. And at the same time, look, what is happening on the banking sector is today, although the RBI has given the liquidity to the banks are not investing. The banks have just invested into reverse repo. We see that today's newspaper also carries a report, the investment of the liquidity which the banks have got through LTRO, yeah. That is in fact being invested back into the repo. So the government is coming with a huge mandate saying, why are you not lending it down to the MSMEs or the corporates? So that is something which the bank is looking into. Going back to the questions which you had assigned to me about the corporates and the digital, what do you expect from the corporate counterparties, bank and clients to drive their own adoption of digital solutions? Basically, look, these are unprecedented times. And actually, we have seen the unpreparedness of the banks, especially with regard to the digital solution, because the banks were absolutely unprepared when it came to the fact of how to handle the situation in this terms of, when the lockdown was declared, the banks are totally unprepared. But now we are slowly adopting to the situation. So the first ask of the day is that they have to adopt and institutionalize the digitization in all the business processes. They have to actually move to paperless processes and digital journey. Remote access of the data has to be given, because cloud-based solutions are something which are very acceptable today, and the government is also accepting it. They're moving on from the on-prem solutions over here. The whole point is about adopting digital solutions, because we have seen it actually on the platform that, look, the banks which were actually participating in the TRED's platform, when they went across in the lockdown, they were unable to participate because they were not able to get the access to the core solutions, core banking systems. So as a result of which the TRED suffered. And that is one thing which we are telling the government again and again, that you have to force the banks to come on the platform and start participating in the platform. So we expect that the banks and the counterparties, especially the buyers, once the lockdown is lifted, that they will ensure that the focus will be to get it automated, to go towards the digitalization of the processes. And that's what I see more focus is all towards. And what we're seeing is, look, we are at the same time, we as an organization also have invested heavily in the sense of the electronic initiatives, especially with regard to the onboarding of the customers. Because when we talk about onboarding prior to March, what we are doing earlier was, we were doing manual onboarding of the clients. So now that we have shifted completely to a digital onboarding solution, what used to take 6 to 7 days for an onboarding, normal onboarding, which requires, agreements and many other things to be signed, KYC to be done, that is completely digital now with the RxL, and we can onboard a supplier within a matter of 2 hours. We are getting, so we are working heavily on, the data which comes from the GST. The GST can give us intelligent data as far as the business intelligence is concerned. So we are working heavily. So we are implementing this concepts of e-signing, e-stamping and all that. E-KYC is also we are trying to. So what we feel that, look, the banks will have a challenge over here because they have the legacy systems. They have legacy issues over here. But I feel that, look, I don't see a day far away when the banks have to adopt digitization as a matter of urgency, as a matter of requirement, rather than becoming maybe we can think about it, but that's not something that's going to be on the forefront, because the need of the hour is that tomorrow when the lockdown also lifts up, the work from home is going to be the thing which is going to be there. So you will have a workforce which is 50% going to work from home. So in such cases, you need to have access to the cloud. And that is something which we feel that, the counterparties, especially the banks and the clients, will do as far as the digitization is concerned.
Thank you, Mr. Gaikwad. Thank you. I'm sorry, I have to step in at this point because I have to just save some space for the questions to be asked. But before that, I request Mr. Rathi of State Bank of India to unmute himself. And I'd like to just put the proposition to him, Mr. Rathi. I happen to be in a position where I am frequently contacting banks to be able to convince them to accept a FinTech product, which is trade assets, as one of the products that they should use for bank risk distribution. And particularly when dealing with the larger banks, the process of onboarding, the process of even coming to a point where they're willing to look at it is so arduous. And so I was wondering, from your perspective as a representative of a very large bank, in fact, India's largest bank, what has your experience been in terms of embracing FinTech initiatives, and how have they rewarded you? How have those technologies rewarded the processing and efficiencies within your bank? Mr. Rathi? Mr. Rathi? I think we don't have Mr. Rathi on board.
Hi, this is Alex. Can I actually partly respond to that? Although I'm obviously not going to give you an answer as a corporate.
Please go ahead.
Two comments really. One is we are setting up, or we've now set up, a FinTech workstream in the ICC digitization group. And one of the things specifically we're looking at doing is assisting the processes of either banks onboarding FinTechs or FinTechs preparing themselves to be onboarded by banks, because the process, as anyone who's worked as a FinTech and selling to a bank knows, is incredibly arduous. I'll give you two specific examples of that. At SDocs, we find on average it takes 3 years to sign up a bank. One bank, who will remain nameless, had 200 individual sign-offs to sign our legal agreement. So the idea of this FinTech group is to try and resolve some of these problems. One of the banks that is about to join was explaining that historically their adoption cycle was 18 months, and that they've just launched a rapid adoption cycle that can get approvals within 3 weeks. So what we're hoping is that banks can share their best practices in reducing the adoption cycle of FinTech significantly.
Thank you for that, Alex. Andre, how much more time do we have? I think we've run out of time, but do we have a few minutes for questions?
Yes,
Andre?
definitely. Yes, definitely. We have one question on the work with regulators to align data residency regulations. Yes. So that was a question more for Sean, or possibly for Alex as well, on is it about data localization, so data residency? Is there any alignment between regulators?
Yeah, so I did actually answer that in the chat. I think this is probably one of the most difficult areas that we have to deal with, actually. So the area in which I've had the most experience of this is at the WTO level. Now, it's very interesting what's going on there in relation to this issue. So data localization or residency is something that actually a lot of the emerging market countries are very sensitive about. And the reason for that is that they do see this as a grab, as a data grab by US big tech companies, and they're extremely worried about that. So they're worried about all their sensitive data going out to the US and being exploited and packaged up and used in ways that are not beneficial for them. So it's something that we certainly try and work on at the. So I explained some of the work that we did at the WTO. Something which a relatively recent development there is, and it's a very pragmatic way of approaching these things. I explained earlier on, I said that trade obviously is global, and that means there's a sort of weakest link problem that we have here. But one of the ways in which you can pragmatically try and progress is to involve simply the countries that are the most influential. the principal countries involved in trade, or the principal countries that have influence. Now, within the WTO, that's resulted in what's called the plurilateral approach, where a group of roundabout, because it was impossible to get agreement of everyone to things like discouraging data localization. So a group of around 80 countries that are probably the most active and the most influential in global trade did get together, and this is essentially this is their policy to discourage, to include provisions within free trade agreements that disapply or prohibit any data localization. But I think this is something that's going to run for a lot longer. And actually, in terms of what influence the COVID-19 pandemic might have on this particular issue, I suspect that actually, given that there is a more intense focus now on tech, that actually, I'm afraid I think that probably a lot of countries will say, everybody is now pushing me to use more technology, and all of this stuff is in the US. I'm actually not happy about this, and I'm going to dig my heels in over my data localization requirements. One of the ironies is, and it was mentioned earlier on in relation to TradeStream, actually, when you look at it, it is in fact people like AWS, Amazon Web Services, that have the ability to data localize. So if the idea of these governments is that actually they're protecting local jobs and somehow preventing data getting out to the US, I mean, that actually is not the case. That will probably happen in some shape or form anyway, and all they will do is discourage local innovation. And discourage competition actually in the services. So you're gonna get this sort of stuff that's being really put into the hands of those very few that can do this on a global scale. So it's actually it's quite a counterproductive position to take. But and it's a bit counterintuitive. So it's difficult to explain that. But that will be an ongoing debate, and it's, I think, probably maybe one of the most difficult issues we have in encouraging fintech adoption around the world.
Yeah, I agree, Sean. And it's also in cross-border trade digitization, it's also a red herring. So we've been working with a number of banks on a replacement to something that's very near and dear to your heart, Andre. The TSU, the Swift TSU. So we've built a replacement for that because Swift TSU is going to be turned off later this year. And one of the banks we've been working with is actually a European bank. They have an internal policy to keep all their data within their country. And we pointed out to them that this is completely meaningless because in a cross-border transaction, the data is by definition shared with someone else. So when you talk about data localization in cross-border trade, how's that possible? So I think, so you need to bring practicality into the conversation, and that's part of the problems that we'll face. And I think I couldn't agree more with Sean's comments that this is actually potentially one of the biggest problems that we'll have. The Chinese will want data in China and will want access to all trade data, as you would expect. The US, vice versa, will be the same. And where does that leave you? Because if you have a platform, you cannot have a platform that has all the data in both countries, because ultimately commercially no one would use it. So this is a big problem and a big thing that needs to be solved.
Okay, very good. I think in the interest of time, we need to come to a close, as some people have other meetings or not meeting, actually calls to jump onto. So I see more questions on the Digital Negotiable Instruments Initiative and other topics in the chat. I suggest I compile those and share our input, certainly the input from the FinTechs, but also ITFA and ICC represented by Sean and Alex, as a follow-up report, if that's okay with you. And we certainly have taken note of sharing key documents such as the most recent papers that ITFA and ICC released, as well as more papers that are being worked on both fronts. Both ICC and ITFA have additional papers being developed, finalized, that will be shared in the certainly next week for ITFA on the TFD initiative, and in the coming weeks, I guess, from ICC, following up on the paper they released yesterday. So I'd like to thank everyone.
Can I just, sorry, Andre, let me just add on this, because there is, quite understandably, we talked a lot about these papers and that we've produced and that ICC has produced. The paper, the digital hacks paper, how to use existing technology to help you with some of these problems we've spoken about, that will be sent out to all our database this morning, so you will get that. Equally, the digital negotiable instruments paper, which deals with both the technological and the legal issues, that is available already on our website. So there is more to come. And the e-signatures paper, by the way, which I mentioned earlier on, this is also available on our website. So do visit our website. It's all on there.
Yeah.
ITFA.org.
Definitely. Thank you. Thanks again to all the speakers, Sean, Alex, Jayan, Christoph, and Srinet. Thanks, a big thanks to Pinaki, without whom we wouldn't be here together this morning. And keep an eye on your inbox, because we're going to share indeed some report from this session, including the papers, the questions that have not been answered. And if you want to get into our mailing list, do not hesitate to send an email via itfa.org or to me, so we can add you to our regular news. And feel free to consult also the website for any more information. Thank you very much again to all, and have a great day. Bye-bye.